Hi everyone, welcome back to Count on Me. I hope every one of you are well versed with the topics that we covered in the last class. In the last class, we discussed about the introduction of accounting, in which we discussed the meaning, definition, and various terminologies used in accounting. For any doubts and suggestions, please contact to the below given email ID. In today's class, we will be discussing about the fundamental and important rules, regulations and guidelines which are used while preparing accounting information. So, fasten your seat belts and let us move on to today's topic. In the last video, while discussing the meaning and definition of accounting, we saw that accounting is an art. However, it is also to be noted that it is a stream of science as well. In order to clearly understand the science behind accounting, one must understand the underlying principles, assumptions, and practices which govern the accounting. Generally accepted accounting principles or GAPs are a collection of such rules and principles based on which accounting is performed. The following are the major heads into which accounting principles are classified. There are four groups of principles in common. They are accounting concepts, accounting convention, modifying principles, and accounting standards. We will discuss each such groups and the principles coming under them in a more detailed manner. Accounting concepts. These are the building blocks of accounting. Accounting concepts are assumptions based on which financial statements are prepared. The main concepts here are entity concept, money measurement concept, going concern concept, and accounting period concept. Let us look into each of these concepts in a detailed manner. Accounting entity or business entity concept. According to this concept, business is treated as a separate unit from the person who owns or manages it. Accounts of the business is distinguished from all categories of persons associated with it. This principle validates the reason for maintaining the capital contributed by the owner as a liability in the balance sheet of the company. In order to understand the accounting entity concept, let us look into an example. Mr. Ram, an individual, started a business of garments in New Delhi with the help of his friend Mr. Shyam. They both started the business in the year 2018. They named their business as R&S Garments Limited. Now, according to the accounting entity principle or business entity principle, though R&S Garments is a company set up by Ram and Shyam, it should be treated as a third party from its owners. Now, R&S Garments Limited will be treated as a separate first person from Ram and Shyam. Money measurement concept. Also known as concept of monetary expressions, this concept ensures that only transactions which are measured in terms of money are recorded in the accounts. The disadvantages of this concept are it does not take into account the purchasing power of money and qualitative aspects of an individual are ignored while recording. Now, money measurement concept simply means that the qualitative characteristics of an individual like honesty, sincerity, love, modesty, empathy, etc., though matters for a business, are not considered while recording a transaction. Only those transactions which can be expressed in terms of money or in quantitative terms are to be considered while preparing the accounts. Going concern concept. According to this concept, business unit is assumed to have indefinite life. It is on the assumption that the business is not started to wind up in the near future. The life of the business is not predictable. Look at the example we discussed earlier. Mr. Ram and Shyam started their business in the year 2018. Now, they started the business not assuming that they will have to wind it up in a near future. They are supposed to run the business for a long time. It is because or it is considered according to the principle of going concern. Accounting period concept. This assumption is an extension of going concern concept. Accounting period concept dissects the indefinite life of a business into a period of intervals of 12 months each. The result of the company is derived by matching the income earned and expenses incurred during the interval. Now, once more, let us go back to the R&S Garments example. How will Ram and Shyam calculate the profit of the business if the business life is indefinite? The accounting period concept helps us here. According to this concept, though the life of the business is not certain, we evaluate the business by splitting it into different intervals like the image given below. Now, it is easy for Ram and Shyam to ascertain the profit for each such intervals. Accounting conventions. Convention denotes a rule or practice or way of doing certain things. Accounting conventions refers to the procedure followed by accountants all over the world. While we discussed the qualitative characteristics of accounting in the last video, we come across a characteristic named comparability. Accounts can be compared between two businesses only if all the accountants around the globe follows same procedure. Accounting conventions are such procedures followed by accountants for accounts preparation. The conventions are dual aspect concept, verifiability and objectivity principle, historical cost concept, revenue recognition principle, matching principle, and convention of disclosure. Let us understand each of these conventions in detail. Dual aspect concept. This is the most basic principle of accounting, also known as accounting equivalence principle. This is the principle based on which balance sheet is prepared. According to this principle, every business transaction has two aspects, a giving aspect and a receiving aspect. Accounting equation is developed on the strength of this principle. Let us understand the concept with the help of an example. Akshay owns a stationery shop in Delhi. Akhil, a student of nearby school, purchased a pen from Akshay. Here, Akshay gives the pen to Akhil and Akhil receives the same. Now, Akhil paid rupees 10 for the pen to Akshay. That is, Akshay received the money and Akhil gave the same. Thus, it is evident from the above example that every transaction that happens do have two aspects, one giving and the other receiving. Verifiability and objectivity principle. The principle states that the data provided in the books of accounts should be verifiable and dependable. Figures exhibited in books of accounts should be supported by source documents like vouchers, receipts, etc. This ensures more accountability and acts as a cross-reference document. Look at the previous example of Akshay and Akhil. How can Akshay, who is the seller, prove that he received the money from selling the pen? And how can Akhil, the buyer, prove that he bought the pen from Akshay? The verifiability and objectivity principle states that every transaction recorded in the books of accounts should be supported by a source document, so to ensure the source of the data entered. Historical cost concept. According to this concept, all transactions should be recorded at their acquisition cost. Cost of acquisition refers to the cost of purchasing the asset and expenses incurred in bringing the asset to the intended condition and location of use. Now, I know that you all may be confused how this can be calculated. Let us go to an example. Mr. X bought a machinery worth rupees 1 lakh. For transportation, he spent rupees 10,000 and an additional rupees 5,000 for loading and unloading. What will be the cost of acquisition of that machinery? Now, let us look into the answer. The historical cost of the machinery can be calculated as follows. Take the cost of machinery, which is 1 lakh, to which add the transportation cost rupees 10,000 and the loading and unloading cost rupees 10,000. Now, what you get will be the total cost of the machinery, which is 1,20,000. Now, from this example, we can understand that the actual cost of the machinery, which we refer to as the historical cost, is not the cost that we incurred to buy the machinery, but it also includes the transportation, loading and unloading charges, and any other expenses in connection with the machinery to bringing it into the intended location and condition of use. Revenue recognition principle. Revenue is the amount which a business earns through the sale of goods or services. As per the principle of revenue recognition, revenue should be recorded at the time when the title of goods passes from the seller to the buyer. This is considered to be the point of revenue recognition. This principle is also known as revenue realization principle. Revenue recognition concept provides for the recording to be done on accrual basis. Accrual basis denotes that as and when transaction occurs. Accordingly, revenue is to be recognized at the time when right to receive money is established. Say, if some customer has paid us rupees 10,000 as an advance for supply of certain products, this amount so received would be recorded as revenue at the time when goods are actually delivered by us to the customer. Matching principle. According to this principle, cost incurred during the accounting period must be matched against the revenue earned during the period. Thus, expenses or incomes of the current accounting period should be matched with the income or expense of the same period. Only by doing so, we will be able to identify and calculate the actual profit or loss that we earn during a particular period of interval. Convention of disclosure. According to convention of disclosure, accounting statements must be prepared honestly and must contain all relevant and material information. Published financial statements must fully disclose the true and fair view of the state of affairs of the concern for a particular period. The convention states that only if true and fair informations are passed on to the end users, they will be able to come up with great and supportive decisions. Irrelevant and immaterial information provided to the users will make clashes. Modifying principles. These are certain advanced principles and practices adopted along with the existing principles. This includes the following: materiality principle, consistency principle, convention of conservatism, and timeliness. Let us look into each of these. Materiality principle. The principle suggests that every material information must be disclosed in the final accounts. An item should be regarded as material if there is a reason to believe that the knowledge would influence the decision of the informed investor. One person's material fact may be immaterial to another. Now, let us look into an example for what is material and what is immaterial. In this example, we will discuss how an information can be classified as material or immaterial. Ajay and Vijay are two friends. Ajay is an international businessman who travels to various countries frequently. Vijay, on the other hand, never even bothered to take a passport. Ajay one day booked for a flight to Dubai, but on the day when he was about to leave to Dubai, the flights were cancelled due to really bad weather condition. Though the cancellation of the flight is an information, it is material only to Ajay and immaterial to Vijay. Thus, it is evident that a same information can be material as well as immaterial. The classification of an information as material or immaterial depends on the user. If the user can take a decision out of the information provided to him, then the information can be termed as material. Otherwise, it is just a piece of information only. Consistency principle. When we were going through the qualitative characteristics of accounting in the last video, we come across a characteristic called comparability. Comparison will be effective only when accounting practices and methods remain unchanged over periods. Thus, There should be a consistent approach while maintaining books of accounts. No accountant is allowed to change the accounting practices as and when they wishes to. In order to change a practice, the accountant must have valid reasons and it should be prior approved. Without a prior approval, no accountant is supposed to change a practice from that we are doing now. Convention of conservatism. The principle is also known as the principle of prudence. It states that while preparing financial statements, accountants shall maintain caution. Thus, accountants shall maintain provisions for anticipated losses and shall not record incomes unless it actually receives. This policy tends to understate rather than overstate net assets and net income. If the accountant is of any idea that in future the company or the business may face any kind of loss, he shall maintain provisions in order to mitigate it. On the other hand, if he is of any idea that in a near future they will receive a certain amount of income, they should not record the same unless the income comes into their hand. Timeliness. One of the most important principles of accounting is timeliness. Accounting information must be made available on time. Financial statements prepared belatedly will not serve any purpose. As it says, information delayed is information denied. Accounting standards and overview. Accounting standards are written policy documents covering the facets of recognition, measurement, treatment, presentation, and disclosure of accounting transactions in financial statements. Accounting standard is to bring consistency in diverse accounting policies in order to eradicate non-comparability of financial statements and for improving dependability of financial statements. On 21st April 1977, the Institute of Chartered Accountants of India (ICAI), diagnosing the necessity to synchronize the diverse accounting policies and practices, constituted the Accounting Standards Board. Subsection 3A to Section 211 of Companies Act requires that every profit or loss account and balance sheet shall comply with the accounting standards. Thank you. I hope the session was easy for all of you to understand. Please mail me your doubts and suggestions to the email ID given at the beginning of the video.